Right, financial instruments. Sometimes it's one of those topics that is vast in terms of its nature and its quantity. If you think about it, I think it takes up probably about 1/3 of the entire set of IFRS pages. What I've tried to do, obviously, in the notes and in the DVD presentation is kind of condense that all into something a little bit more manageable, something that you can at least go and have a look at, come back to. These principles should quite easily, all right, get you through any question. So let's see what are the types of things that we need to look at. Now, financial instruments can be broken down into kind of three things. And I'm certainly hoping that for most of you, you will remember your very first accounting lecture. I'm sure it was probably the very first one that you ever had, all right, where you might have learned this little thing. Equity, assets equals equity plus liabilities, all right, and that comes back here because it breaks it down and says, look, there's something called a financial asset, a financial liability, and equity. In terms of the notes, I've gone through what a financial asset is or a financial liability is. All right, you will see there, for example, cash or contractual obligation to deliver cash, whatever the case may be. All right, but interestingly is when you look at the definition for equity, it's simply assets minus equity, assets minus liabilities equals equity. All right, our old accounting equation coming back. All right. Now, the purpose of the statement is how do we go about measuring a financial instrument? All right. Now, please remember that we are dealing here with monetary items. All right. Cash, loans, debtors, creditors, that sort of thing. All right. We're not talking about PPE or intangible assets or goodwill or inventory or anything like that. All right. We are talking, yes, purely about monetary items. Well, the recognition criteria for each of these, all right, is very much dependent on the category, all right, that it falls under. Now, what do I mean by category? Let's take an example where I go and I decide to buy shares on the stock exchange, all right? So we all realize that I own the shares and it's an asset, all right? So it's a financial asset, it's a monetary item, can be converted into cash, all right? I've got one of four ways of looking at my investment. First one is what we call fair value through profit and loss. All right, so that's the first option that I have. The second way that I can do is held to maturity. The third is a loans and receivables. And the final category, if you want to call it, is available for sale. Okay, so those are the four types of categories that we can have for a financial asset. Okay, and under each scenario, all right, the general rule will be fair value. All right, it's very much a fair value type of statement. All right, it's obviously how you go about calculating that fair value. All right. You will also see that, for example, my shares can't fit into all four. All right, they can only fit into two, all right, typically. But it's important to understand that there are these four categories over there. All right, so let's go through some of these scenarios. In order to classify something as fair value through profit and loss, all right, so now there's my shares, let's say. First of all, it must either be held for trading. In other words, I bought it with the intention of selling it and making a profit, or it must be designated as such. All right. So when I bought the investment, all right, I said I am designating this as a fair value through profit and loss item. Finished. Boom. In it goes. All right. Now there are repercussions for that. All right. In the sense that you can't easily take something out of fair value through profit and loss. Normally, once it's in, it's locked in. Recently, there have been one or two amendments to the statement to try and assist companies in taking something out of fair value through profit and loss. But by and large, for yours and my purposes, all right, let's call it that we're locked in. Okay. So that's the first thing, is it must be held for trading. All right. How do I account for this? Okay. The accounting treatment is such that it's always going to obviously be at fair value. All right. So at every single year end, I'm going to have to fair value this particular item. All right. Initial recognition. So I've kind of preempted, but initial recognition will be at fair value. Subsequent measurement will be at fair value. All right. Now clearly, if I go and buy something and it cost me $100, year end is now 150, there's been a movement between the initial and the year end. What do I do with that? Well, clearly, I'm going to recognize it in the income statement. All right. Fair value through profit and loss. That's why it's called fair value through profit and loss. In other words, as the movement goes up or down, so I recognize it in the income statement. Okay. A couple of things that you just need to be aware of. The first one is the fact that if you have any costs, transaction costs, any costs will be excluded from the asset. In other words, what I'm saying is we are going to recognize that those costs, I should say, in the income statement. Okay, very, very important that you understand that. All right, and I'll go and have a look at an example of that just now. Let's have a look at held to maturity. Well, in order for something to be held to maturity, in other words, to be incorporated into that category, it's going to have to meet the following four things. First of all, it must be a non-derivative item. All right. And if you don't mind, I'm actually going to write these over there because this applies equally over here and over there. Now, some of you might be saying, well, what is a derivative item? All right. A derivative item, all right, are things like warrants and options, basically where if you ever decide to open up a newspaper, normally on the left-hand side you'll see all the share prices, and over on the right you'll sometimes see the options market, speculative type things. For example, what is the future price of wool? All right. What is the future price of wheat? All right. Those can be considered to be a derivative type item. They don't normally exist in the real world. All right. You can't really touch and feel them and so on and so forth. It's not something I'm going to get into now. It's not something that really is part of the CTA syllabus at all, right, whether it comes to financial management either. But basically, that's the type of things that we're looking at, all right. Some of you might have come across things like futures and options and warrants and all that sort of stuff, all right. So anything of that nature would be a fair value through profit and loss. You couldn't have any choice in that. Otherwise, it must be a non-derivative item, all right. So that's the first criteria. To carry on with held to maturity, it must have fixed or determinable payments. Okay. The most obvious example is a government bond. All right. I go and I buy a government bond, and in return, all right, it normally have a coupon rate, say, let's say 10%, and I have R1 million government bond. It'll obviously pay me 100,000 Rand a year. All right, so that is my fixed and determinable payments. Okay. The next is it must have a fixed maturity date. All right. In other words, there must be a point in time when it will actually expire. With a government bond, obviously, the government, you cash it in and the government pays you back the monies. All right. And the final one, all right, and a very important one, is the fact that you must have the positive intention and ability to hold to maturity. All right. So the positive intention, normally quite an easy one. And today I sit there and I say to myself, well, I have the positive intention of holding on to it. All right. It's kind of a thought process. The ability one, however, all right, what you've got to look for is something where a question will say, for example, they've ceded this particular thing to someone else. You no longer have the ability. All right. So just be aware of that. But basically it's saying that there should be no encumbrances on that particular financial asset. So that's the first thing, okay, is how do I get something into a held to maturity type scenario?